the Tech Mahindra results that were just announced a couple of hours before. Tech Mahindra has released its Q2 results for FY26. Although the company's profit is up about 5%, it missed estimates. Meanwhile, revenue was up 4.8% and EBIT rose by 15%. I will soon have my colleague joining us now on the phone line to break down these numbers. But just to reiterate and take you through those numbers again, the revenue, which is the top line of the company, has grown by about 4.8%. Net profit, that's the bottom line, has grown by 4.7%, so very close to the revenue. The EBIT has grown by 15%. That shows operational efficiency for Tech Mahindra this quarter, the quarter gone by. And the margins have come in at 12.1% versus 11.1% the previous quarter. And to help us understand and dissect all these numbers, I have my colleague Jasmeet joining us on the phone line, who tracks the space very closely. Hi, Jasmeet. Take us through the numbers once again and tell us what this means for the company.
Well, right, thank you for that. If you look at the overall revenue picture, it's up 4.8%, which clearly beats the estimate, where it was expected to rise by 3% odd. Well, on the other hand, EBIT was expected to rise by 10%, but we see an uptick by 15%, which is again positive for the company. On the other hand, the positive one would be the EBIT margin. We see expansion of 107 basis points versus the estimates of 75 basis points. But we see a miss in terms of net profit, given the net profit was expected to rise by 13 odd percentage. And we see a rise by basically 4.72%. Now, to quickly sum up and give you all the 5 key takeaways from this particular result would be: margins beat the estimate, while the profit misses the expectations. On the other hand, this constitutes to be the 8th consecutive quarter of margin expansion. We also see that the CC growth is highest in last 10 quarters, currently at 1.6% positive versus negative 1.4% in the Q1. While lastly, the communication segment sees a downtick in this particular quarter. Given the communication is the biggest segment of the company, it sees a downtick by 2 odd percentage, but the management restates that they have maintained a stable deal win in this particular segment. Overall, the attrition remains stable. We see a slight uptick by 2 points at 12.8% versus 12.6% in the previous quarter. So all in all, a good set of numbers, but we see a slight downtick in the net profit coming on the back of reduction in the other income.
Okay, all right. So just to again reiterate those 5 key takeaways for the benefit of our viewers at the moment that Jasmeet highlighted. Number 1 being that the margins beat estimates, but profit misses expectations. Number 2, this is the 8th consecutive quarter of margin expansion. CC growth was the highest, that is constant currency growth was the highest in the last 10 quarters, coming in at 1.6% versus minus 1.4% in Q1. Communications segment sees a downtick this time, but the company has maintained stable deal wins. And the last point being that he highlighted was the LTM IT attrition came in at 12.8% versus 12.6% in Q1. To have a conversation about the results, along with Jasmeet, I have Sushovan Nayak, research analyst at Anand Rathi Institutional Equities. Thank you so much for joining us, Sushovan. My first question to you is, how do you read the numbers and what this means for the company going ahead?
Hi, is my voice audible?
Yes, you are audible. Please go ahead.
So I think it's a very good set of numbers, almost a 1.6% CC growth. I think that's much better than street expectations, because that was in the 0.5 to 1% range from a CC perspective sequentially. And even if you look at the margins, we had expected a 50 pips margin expansion, but that has been 100 pips. Even from a deal wins, it's been great, $816 million, and possibly almost 35% YOY growth here. The only point is, I think the growth that is coming 1.6% CC that has been driven, the IT part of it is 1% QOQ, while the BPO part of it is basically 3.2% QOQ. So the growth has been driven by the BPO segment to a larger extent. The other bit also was, if you look at the headcount, I think the growth in the headcount in the BPO is from 60K to almost 66K, while in IT the headcount has actually declined. So those were just my initial observations on the numbers as such.
Well, right, yeah, thank you for that, Jasmeet Singh joining in. I would like to understand now, given the on-site overall percentage of this particular quarter has increased from being maintained at 21% in the previous quarters. So do you see this impacting the margin going ahead? Well, secondly, I would like to understand, given the management's target of reaching 15% by FY27, and we already see the expansion going well in hand, but a slight impact on net profit. So what are your views on the overall profit impact?
No, I think it's just a marginal increase that is fair. It keeps on happening depending upon the demand requirements on the on-site or the offshore bits on and so forth, right? So I don't think it is something that would be a significant cause of concern because they have been executing on what they have committed from a margin expansion trajectory. I believe the company also had communicated about the 15%. Given the way they are delivering, I think they are on track to deliver the margin expansion. In fact, what we also believe is with the H1B sort of regulatory headwinds that have come, possibly there may be more work that would go offshore, which would actually benefit the company in the improvement of their margins as such, right? So, yeah. Overall, I think it looks very good from a set of numbers perspective.
Right. Thank you so much, Mr. Nayak and Jasmeet, for joining us and helping us decode the numbers from the whole picture.